Fantastic, guys. So I can see that we've had a couple more jump on. So good afternoon, everyone. A very warm welcome to today's webinar, which is on budgets and forecasts from the plan to the profit. So my name is Brigitte. I'm a director here at Hunter Withers. Alongside myself is the fantastic two accountants, Sarah and Tristan. And I'm glad so many of you guys could join us today. So in today's session, we're aiming to provide you practical tools and strategic insights to help you build a robust budget and then going on creating reliable forecasts. So we'll have a dedicated Q&A session at the end, but feel free to submit any questions as you're going along at that bottom screen. But without further ado, let's kickstart right into it. So does this sound familiar? You're looking at your reports at the end of the month and you're asking yourself questions like, why was my power so high? Or why do I have a big tax bill? We've had great sales, but all my cash, where has it gone? So perhaps you're wondering even, are you even charging enough to make a profit on a particular job? Look, we've all been there, and it is unfortunately looking backwards and you're trying to figure out why and what has already happened. This is kind of a reactive management approach, but today's goal is to shift that perspective and equip you with the tools to manage proactively using your financial information to map out your future. So the solution, sorry about that. The solution, the best way to think about your financial planning is to manage your business, is doing like a long road trip. You wouldn't want to start a trip without a map or a GPS. So the budget serves the exact same purpose for your business. First, you need a destination. These are your financial goals for the year, like achieving, say, 15% net profit improvement. The route you plan to take this is where you're going to get to your budget. It's a step-by-step financial plan for the year. But we all know that road trips have unexpected traffic, detours, and roadblocks. That is where the forecast comes into play. It provides you with some real-time updates that help you navigate those changes and will set you back onto your destination. So I'm going to pass you across to Sarah now, who's going to help you build that foundation.
Awesome. Thanks, Brigitte. So this brings us to the next big question. How do we actually build our budget? The good news is there's no single right way to do it. The best method is the one that fits your business, your industry, and the amount of time that you can commit to it. It's about choosing the right tool for the right job. Today, we're going to look at the two most common and effective methods. So number one is the incremental budgeting, and number two is the zero-based budget. So the first and most popular method is the incremental budgeting. So we call this one the fast way because it's very straightforward and efficient. The core idea is simple. You use your financial results from last year as a baseline, and then you make adjustments or increments for what you expect to change in the coming year. Think of it like this. You're not writing a new recipe from scratch. You're just tweaking last year's recipe to make it even better. This method is very quick, it's easy to understand, and it works incredibly well for stable businesses where any major changes aren't expected year on year. So the second method is called zero-based budgeting, which I like to call the strategic way. As the name suggests, you start from a baseline of zero and you build your budget from the ground up. And every single expense, from paper clips to salaries, will be justified based on its value and necessity for the upcoming year. It forces you to ask why for every dollar you plan to spend. This approach is definitely more time-consuming, but it is incredibly powerful and it ensures there is no wasteful spending. Every cost is directly aligned with your current business goals. So let's look at a real-world example for each of them. So we're looking at incremental budgeting. So let's imagine a business called Jenna's Cafe. So last year, the cafe had revenues of 500,000 and spent 50,000 on wages. To create her new budget, Jenna starts with those actual numbers, and then for revenue, she knows she's putting her prices up by 5%, and she expects about 5% more customers due to some local development in the area. So we take the 500,000, we multiply it by 1.05% for the price increase, and again by 1.05 for the new customers, which gives her a revenue budget of 551,250. For wages, she knows the minimum wage is increasing by 7%, and she knows she also needs to hire an extra part-time staff member, which will cost 15,000. So we take last year's 50,000 wages, increase it by 7%, and then add the 15,000 for the new hire. This gives her a wages budget of 68,500. So as you can see, Jen isn't just guessing, she's using last year's actuals and layering on the known concrete changes. This is a pragmatic and effective way to build a solid budget. So now we'll look at the zero-based budget. So we're going to look at a different business. This one's called Construct Co. Last year, they spent 100,000 on marketing. Using the incremental method, they might just add 5% and call it a day. But the director decides to use a zero-based approach. She asks the question, what is the most effective way to spend $100,000 to get the jobs we want this year? The question then forces the team to list and justify every marketing activity. They find that 20,000 spent on magazine ads brought in very low quality leads. 30,000 was spent on their website and SEO. However, that did bring in high quality leads. And then the 50,000 on trade shows was good for networking, but it didn't really result in many direct sales. So based on this analysis, they decide to reallocate their funds. They cut the magazine ads completely and reduce the trade show budget, freeing up about 40,000 to invest in the digital advertising, where the return on the investment is proven. This process is more intensive, but it ensures that every dollar has a strategic purpose. Righto, so now I'll move on to Tristan, who will discuss the budget is static and businesses aren't.
Awesome. Thank you, Sarah. Yeah, it's great. We've built our budget now, and it's a fantastic plan based on the information we had, whether we use incremental or zero-based budgeting. But the problem is the budget is static and it doesn't change with what happens when reality hits. So what happens if a key supplier increases their prices by 20%? Maybe a new competitor comes on the market and is trying to challenge your customers. But on the positive side, what happens if you land a massive contract or a big sale comes through and it changes your revenue projections? So this is where a static budget can't really adapt to these changes. And that's something where we need a little bit more complicated, which is a forecast. So I'm just going to explain in the next slide here what the difference between a budget and a forecast is. So a budget is more like the plan, and a forecast would be more of a prediction. And it's a guide on what's actually happening in real time. The budget is set once a year, normally at the beginning of the year, or if you're halfway through the year, whereas a forecast is updated regularly, normally on a monthly basis or quarterly. So this is doing real-time data with what's actually happening in your business, whereas a budget is a bit more static and is not really dynamic. So the questions a budget asks is, do we hit our target? Are we hitting what we plan to do? But a forecast, on the other hand, is actually saying where we're likely to end up if we continue on this trend. So we're just going to look at this in a real situation that we've come up with. So what's happened is that ABC Consulting, the initial budget for the year, they sat down at the beginning of the year and they thought, okay, we can make 100K this year. So they broke it down to 25 grand per quarter. At the end of quarter one, what they've actually received in their bank and their forecast was $15,000. So this is actually different to their original budget, and it's misleading. It tells them that they're about $10,000 behind where they should be, which in some situations can cause people to panic and think that they're behind budget and they need to do some drastic changes. But instead, we have a forecast, which is real time, and we can see the variance here, and we can see that there's 3 months of actuals plus 9 months of forecast. So what we've done now is we've delayed our project revenue, which we know will now land in quarter 2. And we increased the Q2 forecast to $35,000 because it's flexible, and Q3 and 4 remain unchanged. When we add this up, we still end up at the full year forecast of 100 grand. But by doing this, we know we can stay on track, we can see our goals, and even with a slower start, we can have confidence in our cash flow management and not make panic decisions. I'm going to hand over to Sarah now. She's going to show you one of the most important reports, the variance analysis report.
Awesome. So now we have a solid budget, but the budget is sitting in a spreadsheet and it doesn't do much on its own. It needs to be a living document that guides our decisions. How do we track all of this and make sure that we stay on course? This is where the magic happens, using what is arguably the most important and powerful report for any business owner, the budget versus actual report. In Xero, this is called the budget variance report, and if you need any help finding that, you can just let us know. The layout is incredibly clear and powerful. For each account in your profit and loss statement, it shows you 3 key pieces of information. The budget column, this is your plan, the amount you budgeted to spend or earn. The actual column, this is reality, the actual amount of money you spent or earned. And the variance column, this is the story. It calculates the difference between your budget and your actual results, showing the variance as both a dollar value and a percentage. This simple comparison instantly tells you where you went right or wrong and where your attention is needed most. But the true power of this report isn't just the numbers themselves. It's the single most important question that prompts you to ask, why? Every number in the variance report has a story behind it, and understanding that story is how you gain control over your business's financial performance. So let's take a look at 2 quick examples on it. So a favorable variance, imagine your report shows that your revenue was $5,000 or 10% higher than budgeted. That's fantastic. But don't just celebrate, investigate why. Why was it higher? Did a new marketing campaign perform exceptionally well? Did a key competitor potentially have stock issues? Can you repeat whatever caused the success next month? And then an unfavorable variance would be imagining your travel expenses were $2,000 or 40% over budget. That's a red flag. Why? Was there an essential unplanned trip too close to close a major deal, making it actually a good investment? Or is it spending in that area simply just got out of hand without proper oversight? Asking why turns you from a reactive business owner into a proactive one. You start making informed decisions based on real data, not just guesswork. So if you would like assistance putting your budget into your Xero file or other accounting software, please do reach out to us after the webinar because we can absolutely help set you up and get you tracking correctly. And then I know this can feel a bit overwhelming, but you don't have to do it alone. So this is where we would help you, and we would help turn these concepts into powerful realities for your business. And we can help in 3 key ways. First, we would work with you to create that foundational budget, ensuring it's robust, realistic, and aligned with your strategic goals. And then secondly, if you're planning for a large capital expenditure and need bank finance, we can develop the bank-ready 3-way forecast that the lenders will require. That will include the profit and loss, the balance sheet, and a detailed cash flow. And then third, perhaps most important, we can provide the ongoing accountability. So we can schedule regular meetings to review the progress, help you understand the stories behind your variances, and keep you on track to achieve your targets throughout the year. So our role is to act as your financial co-pilot. Over to you, Tristan.
Awesome. Thank you, Sarah. Cool. So we're wrapping up today and we're going to look at the key takeaways. We just got 4 key takeaways from today. And so the first one is a budget is your financial target. It helps you build a realistic plan, either on historical data or Xero-based goals. The second is a forecast is an evolving prediction. It needs to be updated regularly to maintain a real-time view of what's actually happening and where you're heading. And the third is variance analysis, which is a report that Sarah spoke about, which is really easy to do in Xero. And if you're a Xero client, it's a great report to use. And don't just look at the numbers, ask why is there a variance here, what's happening? And then finally, when you take all 3 of these elements, you put them together, It allows you to be in control of cash flow, be in control of making decisions and making decisions based on foresight, not just hindsight and being reactive. So that wraps up our quick webinar today, and I'm going to go into a section of questions. So if you guys have any questions, please just pop them in the Q&A and on the chat, whatever works best for you, and we'll answer the questions the best we can. Awesome. I'll give you a couple of minutes to answer questions, and if any come through, we'll answer them. Awesome. So just keep popping your questions in there if you want, but I've got a question here that has been asked, so I'm going to ask it quickly to Brigitte. How often should I be reviewing my budget versus actual report? Is it looking at once a quarter enough?
Oh, thanks, Tristan. That's a really important question. The vast majority of businesses that we help and assist with would be reviewing them on a monthly basis. And that's probably like the ideal frequency because it allows you to kind of spot some trends and kind of go, why is that happening? What adjustments do I need to quickly make to then impact the next month before those kind of small little issues might become major problems. But yeah, we also then do catch up with a lot of clients quarterly with our accountability reports as well. And at some point that is sufficient. But yeah, no, ultimately you'd probably want to be looking at it on a monthly basis and glancing at that report just to kind of track how the previous months have gone.
Awesome. Thank you. Are there any questions before we close out the webinar? I'll leave it open for a couple more minutes because we're way ahead of time. So let's see if there's any questions, please just pop them through. Alrighty, so here's a question. So this is great for established businesses, but I'm just starting out and I don't have a last year to base an incremental budget on. So where do I even begin?
Awesome, Tristan. So that's a really common challenge, especially with a lot of new businesses that we see, and we're creating those budgets from a blank slate. Can definitely feel like guesswork. And ideally, you want to have some structured approach to it. So I would say instead of looking backwards, you would need to obviously look forward and build that from the ground up, much like the zero-based budgeting that Sarah discussed. So the simple approach that I would start with would be asking yourself, what are your fixed costs? They're the easiest to predict. List all the expenses that you know you'll have to pay each month, regardless of how much you're going to sell. So these are the kind of things like rent, software subscriptions, insurance, accounting fees, any wages that are going to be fixed regardless. So that would be form your baseline of your budget. The next step on top of that would then start to be researching and estimating what your variable costs would be. So these are the costs that directly tie in with your sales, like the cost of goods sold, the shipping, the sales commission, if you potentially had that. Since you have no history, you'll need to do some research. So you'd likely to get some quotes from suppliers, look at the industry benchmarks, and, you know, talk to other people in that same field to kind of have an educated estimate. And, you know, working with an accountant can potentially help that as well. So then the next step would be to build up that sales forecast. So this is often the hardest part. And instead of picking the biggest revenue number, you would build it up from the bottom, and you'd ask yourself, well, how many customers can I realistically serve if you were a cafe? What will the average sale price be? How many leads or proposals does it take to win one customer? This then creates the forecast that is based on the activity and the capacity, not just outright hope. And then I would suggest that you would want to add a contingency fund in there. Your first budget will almost certainly be wrong, and that's completely okay. The goal is to try to be directionally correct, but not perfect. Build that contingency, say between 10 to 15% of your total expenses to cover any unexpected costs that might pop up. This buffer then gives you the difference between a stressful month and a manageable month. So hopefully that kind of is that 4-step approach. So start with your fixed costs, work out what your estimated variable costs would be, and then build up that sales forecast with the revenue number, and then add in that contingency fund. And that's how I would do it for a new client.
Awesome.
Thank you, Tristan.
Thank you, Brigitte. So there's been no more questions asked in that time. So we're going to wrap up the webinar here today. Thank you to everyone who's come through and watched. We really appreciate it, and we hope that you guys learned something. The slides were attached in the previous email I sent you, and I'll send through a recording of the webinar if you ever want to go back and see what was said. But yeah, feel free to reach out to us if you need any help with anything, or if you want some help with your Xero file setting these reports up. But yeah, thank you for today, and have a good rest of your Thursday.
Thank you.